Hey, Kai here. There are a lot of misconceptions about stock investing floating around the interwebs today, especially on YouTube. This can make it rather intimidating to get started or even continue when we're in the crazy market that we're in right now. But you can relax because I know you've been dying to learn about the 4 modern stock investing myths not to fall for. Let's talk about it. Slap hands, bump this, let's roll. Welcome back, my friends. I hope you're doing well considering the circumstances the world and our economy is in right now. Now, if you're anything like me, you care about our world, the environment, and our community, and you're probably doing everything you can to do for our part. But you can't help but see the opportunities just over the horizon, as well as feel this lingering recession coming. The Federal Reserve and government are playing with the inflation devil as they have been printing and pumping trillions of dollars into our economy. Businesses are closing doors all around us, and unemployment rates are at levels that rival the Great Depression of the 1920s and early 30s. And one of the easiest and most accessible ways for us to make money is the stock market. But there are a few myths I have to air out before I feel comfortable with you starting or building your stock portfolio. So the first common modern stock investing myth I hear these days: you need to own several dozens, sometimes hundreds of stocks to be diversified. Spread out the risk. Have you heard this before? I hear and read about it all the time. You actually need to do the exact opposite. You need to be intentional and direct. By spreading yourself too thin, you actually open yourself up to more risk. Ask any investor in any industry worth their salt. If they'd spread their money equally over several industries they were not educated in, the answer is going to be a no. Investors and financially successful people specialize and direct a vast majority of their resources into a very few concentrated areas. The 3 reasons behind this is because you need knowledge depth, time, and energy. And you cannot have those 3 when you spread yourself out too far. When it comes to a portfolio of stocks, I usually recommend less than 20 stocks as a general rule of thumb. But more realistically, you should really have less than 10 core investment stocks. For me, it's 3 index funds and then 7 individual stocks. The problem with having too large of a portfolio is there's no way you can possibly stay up to date on all the companies and the market. A good analogy would be like buying a house. You wouldn't buy a home just by glancing on Zillow and looking at a few numbers, right? You'd want to walk through it, check out the area, zoning, permits, taxes, even perhaps have an inspector take a look at it and give you his personal and professional opinion. That's the same thing with stocks. You want to pretend it's a house that you're interested in buying. You want to do a complete walkthrough and understand the neighborhood, what has been done to it in the past, and what's the potential for it in the future. People who try to balance dozens of stocks are what I call collectors, and I highly doubt they truly understand the companies inside their portfolio without doing it full time. And what you're better off doing in that case is just buying a mutual fund in that sector or industry that you're interested in. It'll be actively managed by a professional or professionals, and you can track their historical performance. So, to debunk this myth, do not diversify. Instead, specialize and understand. You want to invest defensively, which is something I'll get into in another video, so be sure to subscribe if you haven't yet. Going into the second common myth when it comes to investing in stocks: buy low, sell high. This is a common saying in business, but it's a boiled down version of the truth stripped of all context. You actually want to buy on the way down and buy into deals. The key reason is that no one can actually time the market perfectly. You may get lucky once or twice, but every other time you'll lose everything. The key is to invest and capture as much of the upside as possible without being able to time the bottom of the market. And how you do this with the stock market is not to try to time this point right here, but instead to realize that this dip or crash is happening here, and you continue to buy your way all the way down and on the way up. It may sound counterintuitive, but it's called averaging down or reducing your cost basis. But too many people who try to time the market, they dump all or a majority of their money here and here. And what ends up happening is they miss out on a lot of the gains of right here. The other way to buy is to find deals. For example, let's take Berkshire Hathaway here, which is currently trading at a very cheap price of $275,000 a share. Wow. Now let's assume that everything is solid with the company, leadership is spot on, plenty of cash in the bank, steady growth rate, and little to no debt. And then all of a sudden in quarter 3, which is this coming September, October, Every other company releases horrible earnings and miss all projections, and the entire market tanks, which I talk about in this video here. Now let's play make-believe and Berkshire drops to half the value in a week to 140,000 per share. Now I wouldn't classify that as low, but I definitely would say that it's a deal. We just agreed that it was valued at 280K last week based on all accounts, and the only reason why the stock tanks is because the rest of the market does. There will be plenty of those deals coming up soon, and I've got a video coming out where I talk about the 22 stocks that are on my watch list, so stay tuned for that. So to debunk this myth, don't try and time or find the low. Buy on the way down, all the while looking for major deals. Now, I personally use two different stock apps to invest, SoFi and Webull. I personally like to use SoFi because of their interface and their ability to purchase chunks of certain stocks and funds. And then I use Webull to do all my research and dig into the numbers and buy whole shares of stocks. Now, I got some free money for you if you sign up today with my links down below. SoFi will give you $75 and Webull will give you up to 3 free stocks if you open up an account and you deposit. Details are down below in the description. Let me know what you think of the apps and if you have any questions using them. And the next common stock investing myth is that stock investing is complicated, and it really is not. And I'm not being facetious, I mean it. It just seems complicated when you don't have much experience or practice with it. It's the same as anything else, working on an engine, cutting hair, or fixing plumbing inside your home. They're all complicated until you actually learn the basics, and then it's rather straightforward. Here's me boiling down what the stock market really is. You ready? It's a digital voting game based on emotion. The masses trade on market rumors and the wise trade on individual company data. Once you understand that the market is an emotional voting system, you can quickly identify the good companies and sectors and invest in them when the market panics, or the public, the masses panic, and sends everything tumbling down. But I completely get and understand that it can take some time to learn and practice what the market is all about. Now, to get started off pretty easily and almost promise a long-term gain of 6% plus, invest only in index funds at the very beginning. Here are the 3 that I personally invest in: VOO, QQQ, and DIA. I've talked about them a ton in these previous videos, but basically they track the S&P 500, NASDAQ, and the Dow Jones. There are levels to this game, just like as in anything else, but you don't need to be a professional stockbroker to make great money. For goodness sakes, professionals on Wall Street are wrong all the time. They just have giant hedge funds and the government with billions of dollars to hide behind. We can do it a lot simpler with less risk. Here's how I break down and look at companies. My style is called value investing. I stole it from Warren Buffett. It's not a huge secret, and there are tons of books on it. Check it out on Amazon. I'll probably throw a couple links down in the description for you. The first thing I look at is something called free cash flows to the firm. Basically, it's operational cash flows minusing out or subtracting out capital expenditures. I talk way more in depth about it right here. Second, I look at cash balances. Third, I look at outstanding debt, basically when are they due and how much do they have. And then 4, I look at expenses and see if they're growing faster than revenues. And then lastly, I read up on the CEO and president of the company, check out their history, maybe their resume, listen to what they think or what they're planning on doing with the company. And then, oh yeah, one last one is I also look at the direction the company is going. Are they embracing and even building the future like Tesla, or are they stuck in their ways like certain oil and gas companies that deny climate change and that era of fossil fuels is coming to an end? Now, I know all of that sounds complex, but what if I showed you these 2 profiles of 2 separate individuals? And I'm not trying to pick on anyone here, but if I were to ask you who is in a better situation, wouldn't you be able to answer it pretty quickly? Even at a quick glance, I bet 10 out of 10 of you already know who'd you bet on in the long run. That is exactly what I'm doing with stocks. Now, not to hold any secrets back from you, there are 2 other steps that I do, which I don't and won't get into the details for this video, but if you want me to make another video on it, let me know down in the comment section, or you can also just Google it. What I do is I project out the financial statements 3 years. They're called pro formas. And I do this so I can calculate the intrinsic equity value of the company, or intrinsic equity value of the firm. I then use an appropriate discount rate and determine what the company should be valued at today using a net present value formula. This is all done in Excel. It takes like 2 seconds. Not 2 seconds, like a couple minutes. And then I divide that value by the number of outstanding shares. That gives me what I think each share should be worth today. I then compare it to the current price in the market. If the current price is higher, I won't buy it. If it's lower, then I'll consider buying it. The second way I quickly assess if a company is under or overpriced is I take the inverse of the PE ratio. Basically, I put a 1 dash over the current PE ratio. And then it gives me a percentage, which will give me the discount rate that the market is applying to the company. I then compare that to my educated assumed discount rate, and there we go. Now, I know I already lost half of you right there. I can basically see those blank stares through the screen. Again, these two steps are moderate to more advanced ways of looking at stocks, but once you get the basics, it's really not that challenging. I could teach it to you probably in 5 to 10 minutes. Now, I'm considering doing online classes or even a private live stream to go over things just like this. If you think that's a good idea or it sounds like something that you are interested in, let me know down in the comment section, okay? Okay, so debunking this myth, understand the basic concept of why stocks gain value in the first place, and then see what a single company can do to increase its stock price. And as always, the simplest way to invest in the market is to invest in index funds. Start there. And the fourth and last myth, I need a lot of money to start because I can't afford good stocks like Tesla, Amazon, or Chipotle. And yes, you're right. It'll be very expensive to buy one share of any of those companies. You need several hundreds, if not thousands of dollars just to own 1 or 2 shares. And I know before I said to be direct and specialized, but even that is too concentrated. Remember, we have to invest defensively, and owning just 1 or 2 stocks is not accomplishing that. The answer? Buy chunks. And no, I'm not talking about your overly cute, chubby baby niece. I'm talking about buying smaller chunks of index funds and stocks for as low as $1. I've talked about this in more detail, but I preferably use the stock app SoFi to buy chunks where I can buy $1, $5, $20, literally any dollar amount I want of hundreds of different stocks and funds. So if you're getting started with, let's say, $200 to invest and don't have enough to buy 1 share of Amazon, Tesla, or Chipotle, no worries. These days, you can own part of all 3 companies without buying an entire share. So for example, you've got 2 Franklins. Now you want to invest defensively, so you buy $50 worth of VOO and another $50 of QQQ. Those are 2 index funds that I personally buy. And then with the last $100, you buy $40 of Amazon, $35 of Tesla, and $25 of Chipotle. That adds up to $200, right? Yeah, I think so. I hope it does. But you get the idea. If you own a smartphone, a bank account with at least $1 in it, and a pulse, you can trade in the market for free. There's really no reason not to start and to start learning. So debunking this myth, you're no longer stuck having to buy entire shares of stock. You can literally invest in the market with any amount of money these days. Now, I generally hope you will start investing in the market, even if it's just a few dollars. It's a funny thing what your mind does when you have even a small bit of money invested in something. You tend to track and measure it more closely. A lot of times we don't venture out of our comfort zones because it's unfamiliar and seems daunting. The downsides often seem far worse than the upside. Who else has done that? I know I have. But I want you to know, with that voice, it's not telling you anything that's untrue, but it also can strip you of your happiness and personal growth. Your success is not defined by you turning $100 into $100,000, but it's how many times you're willing to embark on something new, intimidating, and yet persisting to learn a new skill. What I've been talking about in this video and basically my entire channel is starting to build a foundation, not just a financial one, but a mental one that allows you to build an entire empire of successes and failures on it. Here's the thing, success can only be built on top of a solid foundation. Without one, you're left with just empty dreams and ignored failures. Okay, enough ear beating you with my Tony Robbins stuff. Like this video if you liked it, subscribe to the channel to keep up with me during these times, and let me know if you'd like to see an online course or join me in a small private live class of some sort. Love you all, buy a 30-pound kettlebell and do some kettlebell swings. Kai out.